shares. This is the core when learning about the stock market. However, this term is often confused and the proper concept behind shares is often skipped. In this video, we will cover everything there is to learn about shares, so that you will find the next concepts in this sequence easy to understand. For this, 3 questions are to be answered. These are: why did the concept of shares come into the picture? The exact definition of shares. Why shares are purchased. Let us start with why the concept of share came into the picture. We all know that every company is in constant need of finance to grow and improve their business. For this, the company looks at different sources from where they can get money. Traditionally, they get money from loans and other borrowings. However, this form of raising money creates an obligation for the company, along with a requirement to pay interest on top of the borrowed amount. This difficulty gave rise to the new form of raising money for the company by issuing of shares. Unlike traditional methods, the issuing of shares to raise money is considered to be more beneficial and efficient for the company. Now, after understanding why the shares come to be used, we can move to the exact definition of shares. Simply put, the company divides its entire ownership into small parts, and then sells it to the public in exchange of money. Note: total ownership, net worth, market capitalization and total capital of the company all refer to the same thing. This means that the entire capital or ownership of the company is divided into many small parts. These parts are called shares. And when a person buys these shares, he becomes the part owner of the company. For the purpose of understanding, we assume stock and share to be the same thing. For example, a company, X Limited, has a total net worth of 1 lakh rupees. That is, its total value is equal to 1 lakh rupees. This is divided into 100 shares of rupees 1,000 each. Note: this shows the exact formula of market capitalization. That is the product of its number of shares and share price. Now, if an investor purchases 2 shares of X Limited, in exchange of 2,000 rupees, he gets ownership of the company to the extent of 2 shares. This ownership is equal to 2% of the entire company. This example is for understanding. However, in real life there is a small difference. The real company has a market capitalization of lakhs and lakhs of rupees divided into thousands and thousands of shares. An investor cannot buy a large percentage of the company as an investment. This brings us to the next question of why the people buy the shares of the company. Well, we said that the investor becomes the owners of the company, to the extent of shares bought by him. That is the 2% in the previous example. As an owner, he gets a share in the dividend or distributed profit of the company. In the above example, the investor gets 2% of the dividends. Also, as the company grows, the value of the public investment also increases. That is, the share price increases, thus, making the investor gain from his investment. This is considered to be more profitable than any common investment like bank deposits.